in 2023 there was a lot less, quote, dry powder coming in, it doesn't mean that we don't also have all the capital from prior years that remains to be deployed.
The trend looks like it's a downtrend. And as you said earlier, we don't know if we've reached the bottom. So is that something that should be of concern?
This is maybe the most sobering slide of anything we're going to look at today. But more importantly, the value of those exits.
They don't fully grasp the concept of the valuations and how it works. In a simplistic way, just give us an overview of what safe cap valuations are, how it works for early stage startups, and what it really means for future funding rounds.
Why is the cap higher in Silicon Valley and New York? It's just supply and demand.
How much capital you raise and how much do you need? Some of them don't know. They don't actually know how much they should be asking for. They think that perhaps if we ask for a smaller amount, maybe it's more likely that we're going to achieve our goal. But if the long-term goal is actually we need 2 million, should they be asking for more? Will that increase their valuation?
I mean, ventures typically, it's not just linear. There's usually, you're working really hard until you have a big step up in value. It could be a technological breakthrough. It could be, real traction in the marketplace with customers. If you don't raise enough money to get to that, then the investors will be like, well, this is just a temporary thing. And I know that in 6 months they're going to come back. If I have to give up 20% of my company, would you rather give up 20% for 1 million or for 5 million? Down rounds on the rise, shutdowns on the rise. There's a lot of other stuff that's in here that's interesting.
In your opinion, in your expertise and experience, what do you think would be the best way to navigate 2024 in terms of raising capital in the current climate?
My gut tells me, based on 30 years of doing this, that we haven't hit bottom. It's going to get worse. I think there are going to be more shutdowns. But I can tell you it's a lot harder than it is to do it in the Silicon Valley.
Hi, welcome everyone to our next episode of our Fundraising Podcast. As we embark on a new year, we want to just explore the fundraising landscape today, but in order to do that, we do have to go back and review the data from last year. So we're just going to discuss the trends that happened last year, get a bit of an insight into what that means today. And as per usual, I am joined by the founder and CEO of Area Advisors, Brad Furber. How you doing, Brad?
Great. How are you?
I'm really, really good. In fact, I'm pretty excited to get started on this podcast because, as you know, startup founders, CEOs around the world that are raising capital today, everyone has said it's a more challenging climate to raise capital. So it'd be really, really good to just see what the trends are, what the data suggests from last year, so we can just offer this valuable insight to our audience. Over to you, Brad. Do you want to kick off?
What we tried to do is to look at credible sources of data, and PitchBook, United States, and Carta, which is also a United States company. They aggregate lots of data. They do it in different ways, but in order to present a good picture, a snapshot of where we are, Reliant, we want to acknowledge both PitchBook and Carta and some others. And so we're going to go through today and we're going to look at sort of big picture. You can do a deep dive. There's a ton of data, but we want to give a sense for what does the global outlook look like? What are the trends? And then we'll break it down with some specific regions, Europe and the United States. We'll mention Asia a little bit. So let's get going. Okay, so what we want to do here is look at the big picture. We're going to look at data globally. We're going to drill down into Europe and the United States, make a few comments about Asia. And so we want to get a big picture activity. This is looking at globally, the whole world. This is the deal activity. And you can see 2021 was a peak year. It was an outlier, biggest year in probably 20 years, kind of like 1999 during the dot-com bubble, but bigger. And then 2022, the deals started to come down. 2023, a significant reduction. Have we hit bottom? I don't know. Only time will tell. But big picture globally is, there's been a big shakeout, and we're going to get into that. Now, in terms of fundraising, keep in mind, when we look at VC funds, we're looking at how much capital can be deployed. And so this chart is showing new funding of venture firms, both by value and number of funds. So we're looking at dry powder here. So keep in mind, just because in 2023 there was a lot less, quote, dry powder coming in, it doesn't mean that we don't also have all the capital from prior years that remains to be deployed. So there is still a lot of, quote, dry powder in the system. It's just that there's a lot less that's coming in that's new dry powder.
Wow. I have to say, Brad, just looking at these charts from PitchBook, it If I was a founder of a startup that was looking to raise capital in 2024 and I saw this chart, I would be slightly concerned because it indicates there's less deal activity. The trend looks like it's a downtrend. And as you said earlier, we don't know if we've reached the bottom. So is that something that should be of concern for founders and CEOs that are raising capital this year?
For sure. Yeah. I mean, there is less activity. There's less appetite for risk. There's a lot more capital that's being used to shore up existing investments as opposed to going in to make, new investments. So to be sure, it's not like 2021 where everyone was just going crazy and trying to get as many deals done as fast as they could. Now it's longer to do the due diligence. The deal terms we'll get into some of the deal terms, particularly in the later stage, become a lot more difficult. So absolutely, times are tough.
Wow. So far, what we do know is there's the decrease in deal flow and dry powder.
For sure. Both deal activity, that is portfolio company investments, and new funding of venture firms. Now, keep in mind, a typical venture firm will maybe do 14, 15 investments out of a fund, and they do that over a period of years, right? There is still a lot of capital from 2021, 2022, maybe 2020. There's no shortage of capital. The problem is that the deal activity, which is this slide that we just looked at, that's way down. So the quantity of deals that are getting done and the total value of those deals is way down.
Right.
Keep in mind, the time to liquidity for venture is long, right? I mean, 7, 10, sometimes I've been in deals 15, 20 years. On the front end, the people who are willing to make new investments, that is in part based on their perception of when will I be able to get out? This is maybe the most sobering slide of anything we're going to look at today, because you can see in 2021, the exit value was great, both in terms of dollar value and also number of deals. You get down into 2023, there were still 2,613 exits, down from 4,471 2 years ago. But more importantly, the value of those exits is way, way down, right? 2023, we're back to where we were in 2017. If you're going to be an LP, a limited partner, putting new money into a venture fund, and you're looking at this, it's pretty sobering. You're like, well, how am I going to get a return on investment if the exits are few and far between, and the value of those exits is a lot less than, say, they were a couple of years ago?
Wow, indeed.
Let's take a look at just regions. And here what's interesting, again, PitchBook breaks this down: North America, Europe, Asia, Latin America, and rest of world. 2023, the number of deals in North America was still the highest, right? With Europe in third place, Asia, second place. There's still, a fair amount of deals getting done. But if you break it down, really those three markets, you've got North America, Asia, and Europe. We're going to look at Asia in a second because Asia is gaining in strength.
One of the questions that we're often faced with is, where is the best source of capital? So if there's more deals in Asia, what does that mean? What does that indicate? Should startup founders in Europe perhaps should be looking for investors in Asia?
You've heard me say it a million times. You fish where the fish are. If there are funds in Asia that are looking for deal flow in Europe and they're willing to invest in Europe, to be sure, there's more capital available right now in Asia. So it's a big pool of capital, and it's growing. Asia's growing, whereas Europe maybe was number 2 a few years back. Asia eclipsed Europe. Some people think it'll eclipse North America, but to be sure, there's a lot of money in Asia. What else do we want to look at? This slide, again, is breaking down the VC funds by region. And this is really fascinating because here, Asia is now bigger than North America. In 2023, more money was invested in funds in Asia than funds in America, and significantly more than Europe. So getting back to your question, there's a lot more dry powder going into the Asian funds. And for the first time, well, I guess maybe in 2021, Asia was slightly bigger. So yeah, Asia's been strong, you'll see, for quite a while. But the distance between North America and Asia and, say, Europe, the delta is getting bigger and bigger.
A lot of people just assume that, America, Silicon Valley, that's where most of the deals are done. It's quite interesting now that we're seeing the data showing that there's a lot more deal flow happening in Asia. I think that's something to consider for, anyone that's raising capital.
Well, you make a good point. And we can get into where is, and when we talk about North America, I think we have some slides later. It's still true that the Silicon Valley, San Francisco, San Jose area is by far the largest spot. And that's true globally. So there's no place in the world that is even close to the Silicon Valley in terms of portfolio, new investments, or funds under management. I mean, it's not even close. Asia is huge. It includes all of Asia. But it's still true that Silicon Valley dominates in the venture capital space in North America and globally. So again, this one's looking globally at where are these exits happening. And so here you can see Europe actually in 2023 had a very high number of exits. So it's North America had 1,082, Europe 826, Asia 580. So what is this telling us? Well, there is a lot of exits happening in Europe, but maybe the value of those exits isn't all that great, right? So maybe they're companies who have decided to sell at an earlier stage than some of the companies in other regions. Actually, historically is true. I think, unfortunately for Europe, instead of going all the way and becoming a global tech company, they may build something that's valuable, but then sell it to either North American or Asian companies. And that's been going on for a long time. Since you and I are currently in Europe, Yomi, and we do probably talk to more Europeans than any other region. This one's interesting. We just talked about the VC exit activity in Europe. So 2023, it's quite a bit less than it was. Here's the deal sizes by stage. And here, I think one of the things that I find interesting is the delta between the median and the average. Of course, the median is the 50th percentile, whereas the average is all the deals divided by total value divided by number of deals, whereas the median is what if you're just right at the 50% mark. And here, let's take a look at pre-seed. The deal value in Europe was 600,000 euros, whereas the average is 1.1, right? We do, Yomi, as you know, we talk to a lot of folks at the pre-seed and seed stage. Yeah. The median seed is 1.8, the average is 3.2. So when people say, hey, what's normal? It's like, well, do you want to look at the median or do you want to look at the average?
What does that actually translate? What does that mean in layman's? How would the average startup founder interpret this data? What does it mean?
Well, it depends on your perspective. If you line up 100 CEOs of, say, pre-seed companies and you say, okay, show me what the median deal value was for the person who's number 49, number 50, and number 51. If you go from, say, top to bottom, well, then you say, how much did you raise? They would say, I raised 600,000.
Right.
Whereas if you say, hey, what's the average? Well, the average is actually quite a bit higher, 1.1 at pre-seed or 3.2. But that would mean you're not looking at, say, 49, 50, 51. Again, I can't tell from the data here. You might be looking at maybe top quartile. And what happens here is there's some big, huge fundings that happen and they skew the results, right? So I guess the question is for somebody who's a startup founder, who is your peer group? Is your peer group the ones that, are on the front page of the paper and they're the rock star that just closed a $20 million, seed round? Or are your peers more, people that you may have met and talked to, but not necessarily, or not on the front page, and they're building nice businesses, successful businesses, but, the amount of funding that they're getting is quite a bit more modest.
Yeah. And, this is something that I think affects startup founders. When they read articles about, these tech startups that have raised 20 million, 30 million at the seed, the seed stage, they then maybe get this idea that they can also raise 20 to 30 million. So why is it that some startups are able to raise so much capital at such an early stage and everyone else just gets a modest amount? What is the differentiator?
Well, some startups just have a bigger idea and they have more sex appeal. Why does Cristiano Ronaldo or Lionel Messi get, these huge packages, and other guys who are, outstanding soccer players or football players, as you say here in Europe, don't. I mean, that's true in every industry, and it's true in the startup space too. So there are just some companies and some founders that tell a great story, and there's a whole mix of information as to why they're able to close, bigger rounds faster than others who may struggle.
No, you're right. And the reason I bring it up is because you can imagine I'm on the front line. I'm speaking to founders of brilliant solutions every day from all different jurisdictions around the world. It just strikes me as even if you have a really, really good idea or you have a, really brilliant solution, you still need the ability to tell that story to attract investors. And so would you say, you mentioned earlier yourself, storytelling, telling that story, pitching your offer in the right way. Do you think that makes a huge difference in the amount that you're capable of raising?
Yeah, absolutely. The best storytellers are the ones who are able to convince people to take a risk and jump in and invest capital with them because people get excited by it. So you can't be, full of BS, but if you're a good storyteller and you're credible, you have a good team, you got a big market, looks like you've got an innovation, looks like you're going to be a winner. Yeah, absolutely. People want to get behind that.
Brilliant. Well, at least this data is encouraging for early stage startups. I mean, if you can raise what the average there is, the figure that you just quoted, it was in the millions. So that is encouraging for early stage because a lot of them do feel that it's nearly impossible right now to raise some seed capital.
Not possible. No. And again, we're just looking at PitchBook data. Let me toggle over and we'll take a look at the U.S. So the U.S. market, the exit activity, again, you'll see the total number of exits and the exit value. This is a massive drop-off, right? Think about it. From 2021, the exit value, $797 billion to 2023, $61 billion. I mean, that means less than 10%. I mean, look at this. So that's, for people like, well, hey, how come people aren't as excited about investing in early stage or venture? It's, because, look at the facts here. 2021 was massive. Everyone's like, you got to get in. And now 2023 and 2022, frankly, are, 10% of 2021. So that's pretty sobering, right? Yeah. So that's the exit value. We can look at the median pre-money values just so that you can compare. I mean, and until I looked at this data, I was just like, I was flabbergasted if this data is correct. So right now, the screen I'm looking at, we just spent a lot of time talking about EU. In 2023, the median pre-seed deal value was 0.6, and the median for seed was 1.6. And the average was in Europe, 1.1 for pre-seed, 3.2 for seed. If you go over to the US, the median pre-seed deal was 5.7 million, and the seed was 12 million.
Okay.
And the average was 8.3 and 17.9. I mean, that is a massive difference, right? So when you're talking to people, the U.S. is just way bigger. Yeah. You get way bigger rounds and higher valuations than Europe.
Wow.
That might not be true in Asia, but I just did a deep dive in Europe and U.S. So, this is important data, right? So when you're talking to somebody and they're based in, and one of the slides that we're going to get into a little bit later is, what about the differences in the U.S. between, say, Silicon Valley and New York versus the rest of the U.S.?
Right.
And it turns out there's huge differences, right? The U.S. data is skewed because, as we'll see, the Silicon Valley gets about 40% of all dollars invested and deal. So 40% of the money in the U.S. is happening in the Silicon Valley.
Right.
Different industries, it's higher or lower. And the deal terms in the Silicon Valley and New York are better for the founders, I should say, than any other place in America, right? So if you're sitting in Mississippi, you might not be that different than somebody who's sitting in Germany. Right. Probably you'd be better in Germany than Mississippi, but, let's say Colorado.
What about these startups that predominantly are based in Europe? They're looking for outside capital because they don't necessarily feel that investors in their jurisdiction have an appetite for risk. Is it typical for them to look outside and maybe focus their energies on looking for investors in the US? Since there's a lot more deal flow there?
That's a big question. This gets back to how do you fish where the fish are,
yeah.
Right? We've said that a million times. And if you, for example, are a company that's incorporated in Austria and you want to raise money in Silicon Valley, you're probably going to have to reincorporate in the United States. I don't think there's a lot of people sitting in the US that are like, I just want to invest in Austrian companies. There may be some, but not very many. And you got to look at different jurisdictions. The UK is different. And I don't want to say because people might think it sounds like I'm being disrespectful to certain countries. But to be sure, right now, people are battening down the hatches and they're trying to invest in things that they really know instead of just taking a flyer on something in some faraway place. So if you are, for example, from Austria, great country, first world country, a lot of innovation, and you have a global business plan, i.e., I developed this in Austria, but actually I want to commercialize it in, say, North America, you probably do want to head over to the States and get things going over in the States. That would dramatically increase the probability that somebody will back your company, at least if you want the money coming from the United States.
That makes sense. All right, let's see what the rest of the data is showing us.
All right, so why don't we take a look at some other data sets, first look data sets based on 2023 data, and we're going to shift over to look at some slides that have been created and published by Carta.
Carta. So, Brad, just for our audience, who is Carta and what do they do?
Yeah, Carta started out as a cap table management company, and they have a huge number of companies that are managing their cap tables using their system. And then they've evolved so that they also act as a fund administrator for some SPVs and some small VC funds. They were recently in the news and have decided to exit the so-called secondary market, where that's a whole nother thing. But in any event, what they have is they have a lot of data, and it's important and it's valuable data because by managing the cap table and tracking different metrics, they can then publish on an anonymized basis. Hopefully, that's what the controversy was about here a few weeks ago, that as long as they publish this data and it's based on an anonymous basis, it's actually quite interesting. And so, for example, in this case, with the companies that use Carta as their cap table management, that's their universe of data, which is a pretty big universe. They can show, okay, there were 1,030 seed rounds in 2023 that were in the Carta platform, and this is what the data shows. And so what they've done is you can see different industries obviously have different amounts of cash that they're raising on average and also at different valuations. Right now, typically you would want to be upper right quadrant if you're the entrepreneur and not on the lower left quadrant. You can see the bubble that's the furthest left in the lower quadrant is ad tech. So right now, ad tech is not a hot industry. And right now, gaming up in the upper right quadrant is hot. If you just look at priced seed rounds, the gaming companies had, on average, a valuation of 18 million. And you can also see that the size of the seed round is 4.4 million. So right now, if you're a gaming company, you're hot. You can raise money at a high valuation and you can raise, larger rounds. That's what this chart is showing.
Not too long ago, the whole sort of trend and the buzz and excitement was around, I remember we went from sort of blockchain to AI startups. So now what we're seeing on this chart is gaming is the new sort of excitement.
Yeah, in 2023, Web3 is also hot, both, by valuation. Interestingly, HR doesn't sound particularly sexy, but HR is something that's good. Ed tech is good. The question when people call us and say, hey, I've got XYZ innovation, one of the first questions we say is, okay, what's your industry? What is it that you do? Let's look at this chart and say, okay, well, what's my probability of success? Well, the more you're in the upper right quadrant, the higher the probability of success. The more you're in the lower left quadrant, the harder it will be to attract capital.
So what would you say the top 5 are in the upper right quadrant?
Well, I'm just looking at the chart. So it looks pretty clear. Gaming, Web.3, HR, transport, and media. And renewables is good in terms of the amount that's being raised and, also pretty strong in terms of the valuation. Let's look at some other stuff. This one they published, I think, is interesting. It's looking at safes, simple agreements for future equity. A lot of the companies who we work with are using the safe, and we're going to see that the safe has just become, at least in the US, by far the instrument of choice for pre-seed, seed, and those kinds of financings. But what's interesting here is there's different valuations. This is looking at is if a company is raising less than $1 million in a safe round, then by industry, what's the median valuation cap? Okay. So the valuation cap is if somebody's investing in a safe, keep in mind, then that gives them price protection that when and if the safe gets converted into a priced round, that valuation upon conversion won't be more than the cap. All right. And so here, what you're saying is, certain kinds of firms have higher median valuation caps. And in this case, it looks like cybersecurity leading the pack. Marketplaces and ed tech are at the bottom. Right? So if somebody says, well, what should the cap be on my safe? You can say, well, if you want to sort of stay within market terms, take a look at this chart. All right. So this is just data looking at 3,063 post-money safes that were used to fund 910 companies for the first 3 quarters of 2023. I think that's really interesting. So what's the value of the Carta data? Well, they have a large universe of data, so it's pretty valuable data.
We engage a lot of early stage startups, pre-seed round, seed round, and one of the issues that a lot of them have is when it comes to valuation. To be honest with you, they don't fully grasp the concept of the valuations and how it works. So Brad, in the most simplistic way, can you just give us an overview of what safe cap valuations are, how it works for early stage startups, and what it really means for future funding rounds?
So in general, the simple agreement for future equity is an instrument that is not a debt instrument, but it is a convertible security. It's like a warrant, and it allows investors to invest money at an early stage. There's very few terms and conditions, but one of the most important is the valuation cap. And also there's different versions, but for purposes of this, the post-money cap is the most commonly used. And so what that means is mentally, I can do the math and say, okay, if the post-money cap for a company is, let's just say, 5 million, and I invest, say, 50,000, then I now own 1%. That is to say, 50,000 divided by 5 million. I own 1% of the company if and when that gets converted into, say, a Series Seed or a Series A round. Let's just say that because the company took the money, they created value, and they go back to the market, and now they want to convert the safe into a real priced equity round. Let's say that there's a VC firm, and the VC firm says, okay, great, we're going to now invest, say, 4 million at a 20 million valuation. Now, the safe investors get 4 times as many shares as the VC, right? Because there's been an increase from 5 million to 20 million.
Yeah.
Okay. So that's the comfort that the investor gets is, hey, I'm going to provide this capital now. We're not going to negotiate some complicated instrument. But later when you get an investor who is going to come in and professionally price and set in place, hopefully some corporate governance and other terms and conditions, great, I'm going to convert, but I get a better deal than they do because I came in earlier.
Right.
That's what it's all about. That's what the safe is about. It's convertible security.
Okay.
Make sense?
It makes perfect sense. In other words, it's higher risk but higher reward.
Well, you hope so. If you come in earlier, you hope that the rounds downstream are going to be higher. That's what everybody hopes, the founders and the safe investors.
Indeed.
So that's why it's structured that way. And it's intended to be simple and fast.
Okay, brilliant. And would you say it's the most common for sort of early stage startups at the pre-seed seed round?
For sure. Absolutely. The safe has become, and it's increasingly becoming more and more dominant, particularly at the pre-seed and the seed stage. The other convertible security that you see is a convertible note.
Yeah.
Convertible note is debt. So it sits higher. It has more protection to the investor. So the investor actually, all things considered, should prefer a convertible note to a safe. But safes, because they're simple, easy, and cheap, they've become by far the dominant type of security for pre-seed and seed, at least in the United States.
Okay. So let's have a look at this data across the United States. So what is it showing us?
Well, I think this is really interesting. So they're looking at, again, Carta is pulling this data. They've anonymized the data. So of 15,642 post-money safes. What is the 25th, 50th, and 75th percentile in terms of valuation cap? These are post-money valuation cap. And you look and you say, okay, well, the caps are lower when the safe round size is smaller. And the other thing that's interesting is the cap is higher if you're based in either California or New York. And more specifically, I should say Silicon Valley or New York City, because those are two major financial centers and tech centers and startup centers. So they are different. Now, you might say, why is the cap higher in Silicon Valley and New York? It's just supply and demand. So the rest of the country, there's a second tier of tech places like Seattle and Colorado and Boston, certain markets. Boston is also top tier. But, let's say you're based in Texas or Louisiana. I mean, it's just less. Now, as you go through and you raise more money, then the cap tends to go up. That's what this shows. And then they break this down into pre-seed. So pre-seed is, according to Carta, typically $1 million or less. And this is an unpriced deal. And then seed would be more than $1 million. So they go, $1 million up to, say, $5 million plus. And not surprisingly, the valuation caps go up. And that's because there's synergy between the amount that you raise and the valuation, right? Because you don't want to give up 60% of your company by selling a $5 million safe. On the other hand, if you're only selling $250,000 of a safe, you might be happy with a lower valuation cap.
It just seems to me that it's not something that's commonly known how to establish a valuation or a fair valuation when you consider the current climate. What does this data actually tell us in that regard?
What it tells us is there's synergy between the size of the round and the valuation. By that I mean, let's say that a safe is intended to be a bridge to a priced round. And if the bridge is a bridge to nowhere, there's a lot of risk. So the valuation cap needs to be lower. Does that make sense?
Yeah.
Because you're assuming more risk, right? Now, if I know that in order to get to the next milestone, the meaningful milestone, the company may need, say, 18 months and $2 million. And then you say, well, how much are you raising? And they say, 500,000 because I've got like a mini milestone. Yeah. I'm like, I could be investing into a bridge to nowhere. I think this is one of the more interesting slides.
I mean, okay, so let me just ask about that point you've made. When we're engaging early stage startups and we ask, well, how much capital you raise and how much do you need? Some of them don't know. They don't actually know how much they should be asking for. They think that perhaps if we ask for a smaller amount, maybe it's more likely that we're going to achieve our goal of raising, let's say, $500,000. But if the long-term goal is actually we need $2 million, should they be asking for more? Will that increase their valuation? What are your thoughts?
How much do they need to achieve the next major stepping stone? I mean, ventures typically, it's not just linear. There's usually you're working really hard, and then something big happens, and hopefully you have a big step up in value. It could be a technological breakthrough. It could be, real traction in the marketplace with customers. If you know that in order to develop the product or the service, you need X amount of time and Y amount of money, i.e. because you got to develop the product and you got to pay people. And then, of course, you got to market it, right? And there's going to be a natural sales cycle. Then I guess that's the question. If you don't raise enough money to get to that, then the investors will be like, well, this is just, a temporary thing. And I know that in 6 months they're going to come back, or 3 months, or, whatever. So it's a much higher risk proposition. Right. Makes perfect sense. If you really do raise enough money, that you can go 18 months, in the old days, people always said, oh yeah, you should be raising enough capital to carry you for 18 months. Then you can actually do something meaningful and you're not in this constant fundraising mode. Unfortunately, a lot of early stage companies, they're in constant fundraising mode. They're just constantly trying to raise, more and more money. It's a higher risk, and therefore the caps need to be a little bit lower.
The vast majority of startup founders that I engage that are at the sort of pre-seed stage or even seed stage, they don't possess this knowledge. They don't really fully understand how it works. The main thing they know is, okay, I have this brilliant idea. I'm not really sure what the valuation is, but I think we need to raise around 2 million to 5 million so we can scale the business. We have an MVP, but they don't really get into the intricacies of what's the valuation cap? How does that really work? What's that going to mean at a pre-seed versus, a Series A round? All right. So I do think it's really good for you to just make it as simple as possible and break it down in exactly the way you just did.
There's another slide that's in the Carta big deck, which talks about what percentage dilution do you encounter at different stages. And essentially the back of the envelope is for Series Seed and Series A, it's about 20%, but which is another way to think about it. It's like, okay, if I have to give up 20% of my company, would you rather give up 20% for 1 million or for 5 million? It's back to my comment. There's synergy between the money and the valuation. The more money you raise, the higher the valuation, because you're going to end up, in many cases, suffering the same dilution either way. And you might as well get more money if you can. And to the investor, it's typically perceived as less risk because they have a longer runway, they can make more mistakes. It's not always that way. I mean, if they decide to go out and spend the money on stupid stuff, throw big parties, sponsor a race boat and
private jet
party like it's yeah, that's not a good way to spend the 5 million. But if they're capital efficient, like for example, Printify was and is, then it's great. It's awesome.
Okay.
If they're crazy and do stupid stuff like the people who flame out, like WeWork, for example, it's also great.
The next slide is going to be very, very interesting to a large group of founders because, what the narrative is when it comes to raising capital for early stage is, get your pitch deck together and send it to a VC. And quite often, I speak with founders and I ask them, well, is that the most suitable source of funding? Maybe it's too early stage for you. It does raise the fundamental question, who are writing these checks for the smaller deals for early stages? Where is that money coming from? So I'd be keen to dive into this slide and just understand a bit more.
Yeah. Okay. So let me speak to that. So this, again, Carta, the cap table management company, they've aggregated data, and of 19,000 safes signed, and this is before there's a priced round, so these are convertible securities, how big are the check sizes? And in the pre-seed stage, they break it down by round size, right? So under 250 round size, between 250 and $500,000, and between $500,000 and 1 million. What you'll see is there's a lot of small checks, 25,000. So sometimes people say, well, what should be the minimum investment? Well, these are not VCs. These are angels.
Right.
That's what this is. So, okay, there's a lot of small checks. And so if you're trying to raise a pre-seed round, you're probably going to have to lower the quote minimum investment size and get lots of people to pitch in together. You might, and this is just really interesting data, right? I mean, if you collect $10,000, $25,000 checks, then boom, you raise $250,000. I mean, that's simple math. But that does mean you got to close 10 different investors. So this slide is worth examining carefully. And typically the smaller the round, the smaller the check size.
Makes perfect sense. So what is the difference between priced and unpriced? Because it's a term I've heard you use.
A convertible security, like a safe, it has a cap which says that no matter what happens, even if the company becomes, a rocket ship and the next round is at 100 million, I still get the benefit of the bargain of, say, whatever that cap is, 5 million or 10 million. Right. I'm not going to give you money now and then you're going to convert me later when you've already built the value. That's not fair. So that's a priced round, on the other hand, is where somebody says, okay, we're going to come in and we're going to negotiate terms and conditions. We're going to invest, say, $20 million. We're going to take 20% of the company. That's a priced round. And so that means pre-money is 80 million, post-money is 100 million. That's for a $20 million financing. Does that make sense?
Yeah, makes sense. So it does seem that a lot of early stage startups and their rounds, pre-seed rounds or early seed rounds are going to be unpriced.
Yeah, dominant security now in the U.S., at least for tech startups, is the safe, and with convertible notes also still being used quite a bit. All right, so one of the other things we want to do is sort of step back and look at the big picture. And again, relying on some data that Carta published on December 27th, so it's almost a full year, but not quite. They published this document, a deck really, on the state of U.S. startups. And we're not going to go through the whole thing, But there's a few things in particular that we haven't already covered, but we want to cover. And the first one is down rounds. So down rounds are on the rise. And the charts show that for 2021, 2022, and 2023.
Okay, just so for our audience, what is the definition of a down round? What does that mean?
You raised money, for example, in 2021 at a valuation of, let's just say 100 million. Let's say you raised 20 million, 80 million pre, 100 million post. So you sold 20% of your company in a Series A round, and now you've spent the money, you're running out of money. You need to go back to the market, and the investors are saying, your company isn't worth 100 million. I mean, it's a good company, but it's not worth 100 million. So we're willing to invest, say, 10 million at 50 million. Maybe it's 40 million pre, 50 million post. But just to make the math simple, let's say it's 50 million post. Essentially, they're going to get twice as many shares for the same price as 2 years ago. The company has gone from 100 million to 50 million. In the public market, it went from $100 a share to $50 a share. That's a down round. And it hurts. And it's happening more and more. So according to this slide, within the PitchBook, cap table management audience, down rounds are happening 16% of fundings in 2023 for Series A, 14 Series B, 19% Series C, Series D, brutal, 31% of the new financing Series D were down rounds, and Series Z 24. That's a lot, and that's a lot of pain on everyone. The prior investors, the founders, the employees. Maybe they need to reprice the stock options because now the stock options are underwater. So down rounds are not a good thing.
So what do you think are causing these down rounds?
Just the market. The market, we already looked at, some of the data. There's less exits are not happening as frequently, and the exit values are down. And so therefore, the value of these companies is down. The euphoria is over, and people are now starting to think like accountants and less like, marketers, with all due respect.
Wow. So this is a strong indication from Carta that the value of a lot of companies are going down.
Yeah, absolutely. Raising capital now, you're going to have to tighten your belts and accept if you need the capital. The terms are not going to be as favorable to the company, and they're going to be more favorable to the investor because that's supply and demand. It's capitalism.
Got it.
That's why they call it venture capital. All right. So down rounds are on the rise. Now, what's the alternative to a down round? Shutdown. Okay, so better than shutting down is a down round. But if you can't get the down round done, then maybe you just shut the company. And again, what we're showing is that within this Carta cap table audience, companies that went bankrupt, not just quietly shut down and sold off assets in an acqui-hire. This is literally filing for bankruptcy, which is a big deal. In 2023, they had 761 companies in their cap table management audience that filed bankruptcy.
Goodness.
Pretty sobering. And that's only through November of 2023. All right. So down rounds on the rise, shutdowns on the rise. There's a lot of other stuff that's in here that's interesting. Even, in the shutdowns, companies that raised 10 million or more, a lot of those companies also went bankrupt, 121 in 2023. Talked a little bit about valuations and valuation caps. And I think this slide's kind of interesting. How much do you got to give away by round? And according to this data, the pre-seed round, the median is 20.6%, Series A 20.2%, Series B 17%, Series C 13%, Series D 12%. In general, every time you go to market and do a legitimate round, if you're in the median, you're giving up, say 20%. That's a good rule of thumb. This question that you asked earlier, which is what's the type of instrument that you typically see, and different Series A would always be priced security.
Yeah.
But for seed-based companies in first half of 2023, you can see that safes are now the most popular. 50% of the deals were safes. For seed, priced equity was 35%, and convertible notes are 15%. So at the seed stage, if you're using a convertible security, 50% using safe, 15% using convertible notes, and 35% are actually doing a priced round, Series Seed. And you see that safes over the last several years have just come to dominate the pre-seed landscape. So it used to be that convertible notes and safe were about 50-50 or 60-40. Now it's more like 80-20, which is interesting. This is, of course, in the United States. And then in terms of the type of safe, there's 4 different kinds. But by and large, the post-money safe is the large majority. There's other ways you can do it. But the one that is crazy is the so-called uncapped safe. And pretty much nobody uses that anymore because why would you do that if you're an investor? So that's what I've got in terms of state of the state. I don't know what else you want to talk about today, Yomi. What else?
Well, I mean, this is all interesting data. It's certainly shown some concerns in terms of like the downtrends that we spotted on this data from both PitchBook and Carta. If there is an increase on down rounds, for example, and more startups are shutting down, that's something to be concerned about. If you're a CEO or a founder of a startup now and you're looking to raise capital, it strongly indicates that there's less deals that are happening out there. And maybe 2024 is going to continue this trend. In your opinion, in your expertise and experience, what do you think would be the best way to navigate 2024 in terms of raising capital in the current climate?
Well, I'm a big believer in trusting the data. So I think the whole purpose of this is to share with our audience, this is the data. This is the most current data by the most credible sources. And the data doesn't lie. The data is suggesting that it's going to be harder to raise capital, that the deal terms for the founders are probably going to be less favorable than they have been over, say, 2021 for sure. Have we, in fact, hit bottom? I don't know. I mean, I can't predict the future, but my gut tells me, based on 30 years of doing this, that we haven't hit bottom. It's going to get worse. I think there are going to be more shutdowns. There's going to be some people that have really tried hard to hold on that at some point are going to say, can't do it anymore. Maybe I need to go get a job. Maybe I'll put this company, if you're an early stage company, on the back burner. We're not going to file bankruptcy, but we're going to kind of become low cash burn. Those become, in many cases, zombie companies. So it's just a delay in terms of when you actually do shut down the company. It's possible that some of those could phoenix, and 2-3 years from now, things could change and they could reemerge. It's possible. It's just, it is what it is. Now, the flip side is there's still lots of capital out there, and there's lots of examples in prior down markets where the most creative and resourceful entrepreneurs and companies build something the old-fashioned way. And from that will emerge the next, whatever, Amazon, Airbnb, you name it, companies that were able to successfully navigate through an adverse market.
Brilliant. And
I don't know. Does that answer?
It does. I mean, it does seem like a lot of doom and gloom for anyone that's watching this. What you might be feeling is, my goodness, it's going to be more difficult to raise capital. Maybe we haven't hit the bottom yet. There's going to be less deals. So really the question that comes to mind for me is, how does one raise smarter and faster in 2024? What can you do to be ahead of the curve, have the advantage? What could you advise, Brad, that would be the best way to go about that?
I would say it's like anything. You need to be ready and prepared, and you need to be realistic. As you know, Yomi, we offer various programs to try and get people investor ready. If you are serious about trying to raise capital from third parties, and keep in mind, VC is just one source of capital. There's lots of different folks and organizations that can provide funding. But are you investor ready? Do you really know your numbers? Do you have your team? Do you have your house in order? Do you have realistic expectations in terms of the terms and conditions that you're going to try and attract this money? Are you talking to people in the right places? One of the things that we say a lot is fish where the fish are. There is this slide at the end of the Carta deck, which is kind of interesting because we look at aggregate data, for example, for the United States, but the United States is 50 states, right? Or if you look at Europe is, I don't even know, 40, 50 countries. Asia is huge. But really there's certain pockets and places where innovation and finance really is still happening at large levels. And this slide here looks at total capital that's invested within the United States, right? And you can see the Bay Area, which is San Francisco, San Jose, i.e. the Silicon Valley, just dominate. And the second is Boston and New York. Then you got LA, Austin, Seattle, Tacoma. What if you're not? I mean, look at Chicago. Chicago is one of the biggest cities in America. A lot of great companies, industrial type companies in Chicago. But in terms of deals that are done, Chicago's less than 10% of Seattle, or I'm sorry, of San Francisco or Silicon Valley, right? I mean, that's amazing. Getting back to your question, a lot of it has to do with, okay, what do I do if I'm in a quote Chicago, and maybe in Europe, you say, well, what's the equivalent of Chicago? Great city, huge city, but not necessarily a tech or a finance hub. I would say maybe you need to go to one of the tech or finance hubs where your probability of success is higher. Now, that's not easy. Or you try to beat the odds. It's not impossible to be a tech startup founder in Chicago, but I can tell you it's a lot harder than it is to do it in the Silicon Valley. And that's true wherever you are. In Asia, I was recently in Singapore. Singapore is booming. It's they got money, they've got talent, Singapore is rocking. You go up into, say, Malaysia. KL's a nice city too, but the amount of deal activity in, say, KL, Kuala Lumpur, relative to Singapore, is probably similar to the difference between Chicago and Silicon Valley. In fact, it might even be less than that. And KL is a great town. It's a first world town. I like KL too, but you just got to be realistic. And if your innovation needs to be launched in a place where the probability is greater, well, then you're probably going to need to pack your bags and move. You got to do something, right? Or you just accept the fact that it probably isn't going to happen. I know that's kind of harsh, but it's true.
No, again, this reflects some of the conversations I've had with some founders who are based in Europe and actually setting up headquarters in jurisdictions like the US, because they have more interest and more demand for their products in terms of customers, but also to attract investors in these regions, because clearly the example that's shown there is somewhere like Silicon Valley. There's going to be a lot more opportunities to raise capital there.
Yeah. And we could do this in Europe too. By far and away, the UK is the leader, but, there's great pockets of capital. France, Germany, Stockholm punches above its weight on a per capita basis. So I don't want to just say that you got to do that, but because there are some pockets of activity in Europe, and the Stockholm market has for many, many years exceeded on a per capita basis, it's quote punching above its weight. And there's other places like that. As long as we're on this subject, there's another slide that I thought was interesting. This one is looking what are the top markets by industry sector. This is good, right? I'm from Seattle. I love Seattle. I accept that it's not, in terms of the data, one of the top 2 markets. Seattle is home of Microsoft, Amazon, Costco, a lot of great companies, Starbucks. The data doesn't lie here. But the Silicon Valley is not number 1 in every sector. So, for example, gaming, not surprisingly, LA, number 1 in gaming. In medical, in fintech, not surprising, New York is number 1. It's financial capital of America. Education tech, who knew? But New York is number 1. What if, industry, you don't have to move to Silicon Valley. It looks like Miami's emerging. Miami's kind of a cool place. Medical devices, you got, Minneapolis, Minnesota. It's cold. I guess all I'm saying is just like in US, big place, big market, 50 states. Europe, same. If you're living in Germany, probably Berlin is the place to be for a lot of the tech stuff. If you're making cars, go to Munich. Does that make sense?
Makes sense. Fish where the fishes are. So Brad, you mentioned how Singapore is a hotbed. Just thinking about some of the founders I've engaged with that are based in different countries in Europe. So if they don't have any connections or any contacts in, let's say, Singapore, what would be the smartest way for them to actually connect and engage with investors in that particular jurisdiction?
One way to do it is to sign up for an investor engagement platform, right? So even though you're physically located, say, in Germany or Switzerland, are there ways to tap into that market? And the answer is yes. And so we, as you know, forged a strategic partnership with a company that built an investor engagement platform, and they have pre-vetted, essentially accredited investors at this point in Australia, in Singapore, and in the UK. And what's nice about that is by uploading your offering materials, your story and your pitch deck and your materials into the engagement platform, you can then use their artificial intelligence and other tools to target the kinds of investors that you think might be interested in your company. And you can do that regionally. You can say, okay, I'm going to try and target investors who are interested in fintech that are Singaporean, and maybe they have some other fields. And the thing about, my perspective about Singapore is it's amazing how quickly they built that into the financial hub for Asia, at least from the Western world. I think Singapore is now, and it will continue to get stronger and stronger as the hub for finance through Asia Pacific. Obviously, China is huge, but Singapore is different. And I think people from the West have a confidence about the rule of law, the legal system, just everything about it. It suggests that this is a place. It's, Hong Kong is, so yesterday. Singapore is bright, shiny. It's very credible. And this investor engagement is a better way to do that. It's not the only way, but it's a good way to do it.
Yeah, I think that would make sense. I imagine, I see how everything is sort of virtual now. We have these Zoom calls. There's a lot of people that are maybe even pitching investors via video conference initially before they meet them. So it does strike me that having an all-in-one deal room, having, one place where you can manage the entire process of fundraising, but also having the capability of reaching investors in Singapore when you're based in Europe would be a huge advantage in 2024 when raising capital.
Yeah, for sure. And so that investor engagement platform, it's not limited to Singapore. I mean, it's got Australia, it's got the UK, and those are all pre-vetted, quote, accredited. Also, that investor engagement platform has data feeds with non-pre-vetted sources of investors through, for example, Crunchbase. So of the pre-vetted ones, the so-called accredited ones, maybe it's, 32,000. For the others that you can contact through the system that are not, quote, pre-vetted, I think it's up to about another 200,000. So total 230, 240, and it's growing. So it's a lot of fish. It's a big pool, and it's an efficient way to do it. And it's also, as you know, it's just a software as a service. It's a platform as a service. 12-month subscription, no fees, no finder's fees, or whatever. It's a platform.
Sounds great. And I also like the fact that it's an intelligent platform. So not only is it using AI to match you with, suitable type of investors, but it also gives you the ability to invite investors in from outside their network, and I think that's a brilliant thing, because if you have some, if you're based in Europe, for example, and you want to target investors in Singapore, but there happens to be investors that may be suitable outside of the network that's on the platform, you can easily do a campaign and invite investors in from, let's say, the US into your deal room.
Yeah, not only can you invite them in, you can see, what are they looking at? Which pages are they interested in? And the ones that have the most interest or maybe the most questions, you can create frequently asked questions. So it does give you a way to intelligently monitor who really is interested, and then prioritize your communications based on people that actually have invested time at looking at the documents, which a lot of times when you just blast them out, you don't know, did they even open the email, or did they look? I mean, but with this investor engagement platform, when did they log in, what did they look at? It's a much better way to sort of manage the process.
So final thoughts, Brad.
Well, it's 2024, and I'm an optimist. Whether we've hit bottom or whether we're back on the upswing, I mean, the good news is there's a lot of great things happening. There's a lot of capital, innovation. So I'm always optimistic. And a lot of times for those who roll up their sleeves and are willing to do work, hopefully 2024 will be beginning of many great things. So I'm optimistic.
Thank you very much for that roundup, Brad. So thank you to our audience for tuning in for this latest round of our fundraising podcast. And remember, if you like our content, please share it. Like the content, comment below. We'll be very, very happy to hear your questions and answer your questions and engage with you. And don't forget to click the notification bell so you can be notified when we release new content. We will be seeing you again on our next round of a fundraising podcast. And until then, guys, stay optimistic and stay on the grind.